As a beginner to the world of trading, it's handy to understand some key phrases. The stock market index, the S&P 500, the DJ30 and the DJ20. The stock market index is a method of measuring a section of the stock market. Many indices are cited by news or financial services firms and are used to benchmark the performance of portfolios, such as mutual funds. The most common and biggest indexes in the US are the S&P 500, Standard & Poor's 500 stocks, the DJ30, the Dow Jones 30, or commonly known as the industrials, the DJ20, which is the Dow Jones 20, which is also more commonly known as the transports, and that is the top 20 transport companies as decided by capitalization in the US. Stocks and shares. The terms are commonly interchanged. To buy a stock is to buy a percentage of a company, and also in shares. So you can buy stocks and shares. Shares is the word commonly used for stocks in places like the United Kingdom. Bulls and bullish. A bull market is a market that has its primary trend as going upwards. This means in general the key indexes are rising. Why is it called a bull? Some believe the phrase was coined in the latter part of the 19th century. However, what is important is how to remember what a bull market means. Imagine, if you will, you were being attacked by a bull. The bull would charge towards you with its head down and then attack with its horns surging upwards. This is the same as a bull market, attacking in a strong upward move. The same analogy applies to being bullish on a stock, or in general, being a bull means you're optimistic. Bears or bearish. Bear markets are anything but restful, especially for someone invested in the stock market. A bear means indices are in general in a downward trend. The simplest way to remember this is to envisage a bear attacking you. It would be standing on its hind legs, towering above you, and reaching out a clawed paw. It would take a mammoth swipe down at you. Down is the direction of the bear, and people who have turned bearish on a stock are also holding the pessimistic view that the stock will be moving downwards in price. Going long or buying a stock. Going long refers to buying a stock in the hope that its price will increase and you'll gain a profit by selling it at a higher price. Going short or being on the short side means you borrow a stock, sell it, wait for the stock price to go down, and then buy it back at a lower price, then return the stock to the person you borrowed it from, therefore realizing a profit on the difference. Options, puts, and calls. Options are similar to going long and going short, apart from the large exception that you don't actually buy the stock. You actually purchase a contract that allows you to buy or sell the stock at some point in the future for a specific price. It's a contract between a buyer and seller that gives the buyer of the option the right, but not the obligation, to buy or to sell a specified asset on or before the option's expiration time at an agreed price. That's called the strike price. A call option gives the buyer of the option the right to buy the underlying stock at the strike price. A put option gives the buyer of the option the right to sell the underlying stock at the strike price. It is indeed quite a complex tool to use to make money, and option trading is normally a specific course all by itself. The specifics of options trading will not be covered in this training course. We will essentially be going long, and what you will learn will also enable you to go short. Understanding the direction of a stock is key to both. Wow, you're still here. Well, I guess you must have liked this video. If you did, don't forget to hit the like button. It will really help the channel out. and click subscribe if you want to be notified about future stock investing lessons, strategies and software videos. Finally, don't forget to leave a comment or question below and I will reply.